The global shipping industry is hiding a multi-billion-dollar secret right in plain sight. And it all starts with a massive 400-meter megaship that is perfectly capable of cruising at 25 knots, but deliberately chooses to crawl across the ocean at a snail's pace. If you think time is money, the maritime world is proving that moving slower is actually how you make billions. To really understand why a multi-million-dollar cargo ship would voluntarily put the brakes on, we have to look back at the chaotic financial meltdown of 208. In the years right before the crash, global trade was absolutely booming. Consumer demand was through the roof, and optimistic shipping companies went on a massive shopping spree, ordering giant new fleets of vessels from shipyards across Asia. But building a megaship isn't like manufacturing a car. It takes years of complex engineering. By the time these state-of-the-art vessels finally hit the water, the global economy hadn't just slowed down, it had completely collapsed. This created a perfect storm that caught the entire shipping industry off guard. First, consumer spending plummeted globally, which meant there was suddenly way less cargo to actually move across the oceans. Second, that massive wave of newly constructed megaships all entered the market at the exact same time, creating a severe oversupply of vessels. With too many ships chasing too little cargo, freight rates completely crashed, sending profit margins into a tailspin. To make matters even worse, the price of bunker fuel, the heavy, thick oil used to power these massive engines, skyrocketed to historic highs. Shipping giants were burning through cash at an alarming rate, staring down catastrophic financial losses. That is when Maersk, the world's largest container shipping company at the time, decided to pull a radical, counterintuitive lever. Instead of trying to deliver goods faster, to beat the competition, they ordered their captains to do the exact opposite, throttle down. They took massive vessels specifically designed to cruise efficiently at 24 knots and slowed them down to 21 knots. This experimental practice quickly became known in the industry as slow steaming. As the economic crisis deepened and fuel prices kept climbing, they pushed the strategy even further, dropping down to extra slow steaming at 18 knots and eventually to super slow steaming at just 15 knots. The financial results of this desperate gamble were absolutely staggering. In the first quarter of 209, Maersk had posted a devastating $373 million loss. But just 1 year later, in the first quarter of 210, after implementing widespread slow steaming protocols across their entire fleet, they posted a massive $639 million profit. That is a $1 billion financial swing achieved not by working harder or faster, but by slowing down. To see how a drop of just a few knots creates such a massive economic shift, we have to look at the raw physics of dragging a massive ship through the ocean. Moving a vessel that weighs upwards of 150,000 tons through deep water requires an astronomical amount of energy. But the relationship between a ship's speed and the engine power required to hit that speed is definitely not a straight line. In maritime engineering, the power required to overcome water-resistant scales cubically with speed. This means if you want to double your speed, you don't just double your fuel consumption, you multiply it by 8. Conversely, a small reduction in speed yields a massive exponential drop in fuel consumption. Studies show that dropping a ship's speed by just 10% reduces the engine power required by an incredible 27%. And that 27% reduction saves an unbelievable amount of money. Let's break this down with a real-world example. Imagine an 8,000 TEU container ship, which is a vessel capable of carrying 8,000 standard 20-foot shipping containers. At its optimal design speed of 24 knots, this single ship will burn roughly 225 tons of heavy bunker fuel every single day. By slowing down by a mere 3 knots, the ship saves 75 tons of fuel a day. With bunker fuel prices frequently hovering between $600 and $800 per metric ton, saving 75 tons equates to keeping up to $60,000 in the bank every single day that ship is out at sea. On a standard 30-day voyage from Shanghai to Rotterdam, slow steaming saves a single ship $1.8 million in operating costs. When you multiply those savings across a massive global fleet of 500 vessels, you see exactly why shipping executives fell in love with this strategy. Fuel costs generally make up 50 to 70% of a ship's total operating expenses, so cutting that bill down rewrote the rules of maritime survival. But the true genius of slow steaming goes far beyond simply saving money on fuel. It fundamentally rewrites the economics of global supply and demand. Remember that massive oversupply of ships that hit the water right as the 208 financial crisis began? Slow steaming solved that problem too, using a strategy known in maritime economics as absorbing excess tonnage. Here is how it works. Ocean freight operates on incredibly strict published schedules. A manufacturer in China expects a ship to leave port every single Tuesday, and a retailer in Europe expects that cargo to arrive on a specific date. If a shipping line is running its ships at full speed, A round-trip voyage between Asia and Northern Europe might take 60 days. To maintain a weekly departure schedule on that specific route, the company needs to deploy a fleet of 9 ships in a continuous, non-stop loop. But what happens when you slow all those ships down? Suddenly, that 60-day round trip stretches out to 75 days. If the shipping line still wants to offer that exact same weekly departure to its customers, those 9 ships are no longer enough to complete the rotation. They are simply moving too slowly to get back in time. To maintain the schedule, the shipping line is forced to insert 2 or 3 extra ships into the loop. By slowing down the global fleet, the industry artificially soaked up all the extra, unused ships that were just sitting idly in harbors. They effectively decreased the supply of maritime transport. And in basic economics, when you decrease the supply of a service while demand remains steady, the price of that service goes up. By running slower, shipping companies saved billions on fuel and artificially propped up freight rates, allowing them to charge their customers more money. Of course, in a closed economic system, if the shipping lines are winning, someone else is usually losing. In the case of slow steaming, the losers are the cargo owners, the retailers, the manufacturers, and ultimately, you, the consumer. For businesses waiting on goods, a longer voyage time is a heavy financial penalty. This introduces a concept known as pipeline inventory cost. If millions of dollars worth of electronics, apparel, or automotive parts are sitting on a slow-moving boat for an extra week or two, that is massive capital tied up on the ocean doing absolutely nothing. It forces companies to hold way more safety stock in their domestic warehouses to prevent running out of goods, which increases storage fees and slows down their overall cash flow. There are also severe mechanical hurdles to deal with. Marine diesel engines are engineering marvels designed to run optimally under intense continuous heat and heavy workloads. Running a massive engine at half power for weeks on end can cause extensive carbon buildup, accelerated wear, and serious damage to critical engine components. To safely execute slow steaming without destroying their assets, companies have had to invest millions of dollars in derating their engines. This means mechanically adjusting fuel injection timing, modifying exhaust valves, and swapping out turbocharger components so the engines can run efficiently and safely at ultra-low speeds. Then there is the legal side of things. Maritime law has centuries of precedent stating that a ship must proceed to its destination without unreasonable delay. Intentionally crawling across the ocean just to save a buck technically violated many older shipping contracts. The industry had to completely rewrite its legal frameworks. As a result, new standardized legal clauses were introduced in 211 to legally protect ship owners who decided to prioritize fuel efficiency over speed from being sued by angry cargo owners. Today, the industry is evolving from basic slow steaming to what experts call smart steaming or virtual arrival. In the past, a captain might burn thousands of tons of fuel racing across the Pacific Ocean at maximum speed, only to arrive at a backed-up port and find severe congestion. The ship would then be forced to drop anchor and idle for a week, wasting time and energy waiting for an open berth. Smart steaming completely eliminates this waste. By utilizing live satellite data, constant port communications, and dynamic routing software, ships now adjust their speed in real time based on actual port conditions. If the destination port is backed up, the ship simply slows down even further mid-ocean, conserving maximum fuel and arriving precisely when a berth opens up. The era of the high-speed maritime race is pretty much over. It turns out that sometimes the absolute fastest way to grow your bottom line is simply to slow down.